Welcome back to Finance Friends. I'm your host, Fabian, and this is season 4. This season, we're diving deep into the world of investing. Not just where to put your money, but how to think like a professional investor. We are bringing you conversations with highly intelligent, incredibly motivated investors. With weekly episodes, make sure you stay tuned in. Today we had Martyn Simpson, who's lived in 5 countries, including a stint in Iraq. He's the portfolio manager at Colchester Global Investors, a roughly about $45 billion fixed income fund manager. He talks about investing in government bonds all around the world and factors that influence the performance of those bonds. Have a listen in. Welcome, Martyn, to the Finance Friends podcast. How are you today?
I'm good. Well, thanks for having me here.
Well, It's good to have you on board. We were just talking. It's almost 5 o'clock, 5 p.m. that is, and we're just talking about getting a coffee in Melbourne, and a lot of the good cafes in Melbourne don't open past 3 p.m.
Well, that was it. Mom told me on the way. She said we're at that hour where the coffee shops have shut, but it's probably too early to get the beer in, So,
well, I haven't had anyone have a beer before the podcast. Maybe after the podcast.
We did find somewhere to get a coffee.
A bit of liquid courage never goes astray. But thanks for coming in. So you're where are you living at the moment?
Well, I'm actually living in Dubai at the moment. I moved there about 18 months ago. I used to live in Singapore. I was in Singapore for about 12 years. Moved out to Dubai, so like I say, about 18 months ago. So I had about 17 and a half months of good. The war, not quite so good,
Yeah. Well, we are recording this, the 18th of March at the moment. So obviously Middle East is in massive conflict at the moment, and lucky to get a flight out to Australia.
Yeah, it kind of, I don't know if it's funny, but it kind of kicked off over a weekend about 3 weeks ago. And I think everybody thought, this will just be a couple of days.
Yeah.
So I don't think anybody was hitting the panic button. I was meant to be down here because I'm doing a conference tour with our marketing team here.
Yeah.
And it kind of got to Tuesday, Wednesday, and it didn't look as though it was going to finish anytime soon. So we were looking at trying to get out through Saudi Arabia, trying to get out through Oman. Eventually, I did manage to do it, but... it was a bit touch and go.
Well, you're here today, which is that all that matters. So, so maybe just to run through, you work at Colchester Global Investors. They're a UK founded in the UK. Is that right?
That's right. So the company was founded in 1999 by 2 gentlemen, Ian Sims, who's now the chairman, and a guy called Keith Lloyd, who's actually from New Zealand. But don't hold that against him, you Australian listeners. And he's the deputy CIO, CEO. So it started obviously very small, but now we're about 45 billion Aussie dollars under management. So the company's grown over time, but still the headquarters are back in London.
Yeah, so that's great. And so your role at the moment, it's you're a portfolio manager. Is that correct?
That's correct. So. Technically, I'm one of the senior portfolio managers because I've been there about 11 years. Maybe if you just stick around, you get a nice title. And we invest purely in government bonds and currencies. So that's been my focus almost since the start of my career, is in fixed income, largely in government bonds.
Yeah, okay. And we talk about government bonds and currency.
Yeah.
How much of a weight do you put on like the actual underlying bond versus the currency? Are you currency managers? Are you fixed income managers? Are you, I guess, both?
I suppose we're going to be a bit of both, but what we say is that we try to add 2/3 of our alpha from bonds and 1/3 from currency. Because you're hiring us to be a bond manager, not necessarily a currency manager. It goes along with it.
Yeah.
And over time, that's kind of the split that we get. But obviously, we've got to, if you think about it, you've got to think about both parts. I always like to give this example. If you think of my favorite banana republic, the United Kingdom, if you'd have invested, say, in government bonds around Brexit, you'd have done quite well because they rallied because it was a big shock to the market in the UK. But at the same time, sterling fell about 10% on the day. So if you'd have done that without taking the currency into consideration, it wouldn't have looked that great in hindsight. So you've got to look at both of them when you're investing internationally in bond markets. So that's what we believe anyway.
Yeah. And do you only focus on developed world, like, UK, US, Australia, etc., or do you look at countries outside of the Western world?
We look at the full spectrum. So we say we do government bonds, but we go from all the way, as you said, Australia, US, AAA rated countries, all the way down to our frontier fund. The frontier fund isn't available in Australia, but we've got an emerging market fund here and a developed market fund and index links. So kind of all flavours of government bonds.
Yeah. Okay. So across different, how do you, obviously your team's a global team, so you must work together with other, analysts and other portfolio managers to have a bit of a house view. Is that right?
I mean, we're very much valuation driven, so that's what kind of drives us. But underneath those valuations, we check that, let's say, the fundamentals in the country are solid as well. And that's where the teamwork comes in, and we all work together covering different countries to ensure, I suppose, that the valuation is justified, i.e. that, the country underneath is, I suppose, at the end of the day, going to pay us back. There's foundations are secure.
Yeah. So what are some of the things you look for to make sure the foundations are secure?
Yeah. Well, I mean, I suppose we look at it from two angles. Let's say when we're looking at the government finances, quite simply, how much taxation do you bring in? Do you have a deficit or a surplus? Kind of economic fundamentals that I think most other asset managers would look at. We also look at it from an ESG perspective, and you think, well, how do you do that in government bonds? Well, to us, G is the most important, the governance. I say that because it's very hard to think of a country in the world that's got good environmental standards or good social standards that doesn't have good governance at the top. And what do we mean by governance? It's not necessarily, Bob Hawke drinking the world's fastest yard of beer at the top. You're probably not going to get a prime minister like him every time. But what you do is you look at the institutions that are there. And if you've got strong institutions, even if you get the odd lemon in charge, the institutions keep the country going. So an independent central bank, civil service that's not corrupt, all these kind of factors.
Yeah. And do you look at how big the government debt is? Because there's a lot of talk around the US, debt ceiling and what that is as a percentage of GDP. How much does that play into, your decision making as to where you allocate capital?
Yeah, obviously it's a big factor. I suppose, in its simplest terms, if I go to the bank and ask for some money and I'm already mortgaged to the hilt and I've got a car loan and I've got a loan that I've rent on for my last holiday, the chance of your friendly bank giving you more money decreases. And I suppose it's like that for governments to a certain extent, that the more indebted they are, I suppose in some ways, the more reluctant we are to lend them more money. Now, you've kind of picked on the US there. They do have a lot of debt. I'd be a bit more worried about, say, countries like the UK, because I think the US, with its unique position in the world, has a good ability to bring capital in. Yeah. So I don't think you're necessarily going to get a buyer's strike on US government debt, or at least not yet. Whereas, you saw the Liz Truss incident in the UK. It could have happened a bit more likely in a slightly smaller economy where debt levels are high. That would probably be a bigger worry.
Yeah. And for our listeners, can you maybe just in layman's terms explain Trussonomics and what the UK gilt, which is bonds in Australia, what actually happened there?
Yeah. Okay. Well, I think Liz Truss was a bit unlucky in some ways, because if you remember, it was kind of just post-COVID. So, I mean, what she essentially said she wanted to do was cut taxation, and she wasn't going to fund that taxation from somewhere else. So in other words, we're going to cut tax. Her idea was if tax levels are lower, the economy is going to be freer, entrepreneurs are going to go out there and make more money, and eventually that will bring more money into the government coffers. Now, if she'd have done that 12 to 18 months earlier in the middle of COVID, when lots of governments around the world were spending lots of money, I think she'd have got away with it. But I think because it was post-COVID, everybody started to worry about the money we had spent during COVID. So this kind of plan of we're going to cut tax and hope that it brings in more money didn't really meet, let's say, the zeitgeist of at the time. And once again, I think it shows how powerful bond markets can be, because if people aren't prepared to lend you money as a government and you need that money, which like the government did at the time, then things can go wrong pretty quickly.
Yeah. And is that ultimately what's happened in some countries like Argentina, for example, where the government hasn't been able to pay back their debt and have to default?
Yeah, I mean, obviously, this is a bit further away from the
Yeah.
UK, I'd like to think, but that's exactly it. In countries where they borrow too much money, or another factor is they borrow too much money, especially for Argentina, in US dollars. Because what happens if you borrow in a foreign currency is if your currency starts to go down in value, your ability to repay in a different currency starts to go down as well. And it can move down very quickly. Often you've seen in, I'd call these kind of frontier markets. They're not even emerging markets now. In some of these frontier markets, it's normally the foreign debt that's the real problem, because their currency starts to fall. Investors lose confidence. It goes down even further.
Yeah.
And your ability to repay in that foreign currency really gets hammered. Normally it's an IMF bailout that kind of stops it.
Yeah, so it's just quite interesting because obviously, there are rating agencies around the world, like Fitch as an example, and I think S&P.
Yeah, Moody's, they're the big three. Yeah.
Yeah, so they're the ones, and they'll effectively put a rating on government bonds, but also corporate bonds.
Yeah.
And generally, and maybe it would be good for you to share your insight to this, depending on the rating they give them will sometimes determine the rate at which these, governments or credit houses, or companies can actually borrow at. Is that right?
I think that there's a lot in that. Now, let's say, for example, the US got downgraded by some of the rating agencies from AAA. Did that really make a difference to what the US could borrow at from that AAA to AA? Probably not much, if at all. If you look, though, between going from triple B to double B, in other words, going from investment grade to sub-investment grade, or as some people call it, junk, that could make a big difference, because suddenly you go from perceived as safe to risky. There's a big cliff there. And certainly moving down that kind of level can significantly increase your borrowing costs, not just as a company, but as a government as well.
Yeah. And we talked about obviously currency and selecting the right investment valuation driven. Can you maybe share some insights into what other macro factors affect the price of bonds?
Okay. I think the biggest macro factor that affects, let's say, developed market bonds is the rate of inflation. And why is that? Well, it's called fixed income, kind of, for a reason. And that's because what the government pays out is normally fixed. So, for example, if the Australian government issued a new 10-year bond tomorrow, a 4% coupon, then you will get paid 4% every year for the next 10 years. And in the final year, you'll get all your money back. The problem is that if inflation jumps tomorrow to 6%, then you think, well, every year I'm making a real loss on that income coming in. So what will happen is the price of the bond will come down, and just by bond mathematics, that means the yield you get, or your kind of interest rate, will go up. Yeah, okay. So if you get high inflation, it's very bad for bond investors normally.
Yeah, so there's an inverse relationship between interest rates or high inflation, which results generally in high interest rates.
Yeah.
And then the price of the bond, because that is the bond price will float. Is that right?
I mean, the best example I can give you is, let's say today, the Australian government issue that 10-year bond at a 4% interest rate, and then the next day they issue one at 6%. Which one would you want? Well, you'd want...
Of course, you'd want the 6%.
The 6%, yeah. So what happens to the price of that 4% one that you bought the day before? Well, it falls until you can get a 6% return from it, because otherwise nobody would buy it. So you get that inverse relationship between yield and price.
Yeah, it's quite interesting, because when I started working in financial advice, I had finance degree, but I didn't really know a lot about bonds. And as a financial advisor, you sort of taught in basic terms that, if someone is a risk averse investor, they invest in fixed interest instruments.
Yeah.
But ultimately, the capital can go down in value if, as we saw in 2022,
I think, is the worst one. Yeah.
Interest rates went up really quickly, rapidly, because there was so much free cash in the market, and inflation rose rapidly, and as a result, bond prices went down quite quickly.
Yeah. And that, in some ways, everybody remembers that because it was so unusual. Normally, if you do invest in fixed income products they are, or certainly investment grade or government bonds, normally they are very stable, and that's why people are buying into them. So that kind of one exception in probably the last 20, 30 years is the one that everybody remembers because it's very unusual. So, but you are correct. I mean, there's no guarantee with this kind of thing.
And the other thing is, do you when you look at different investments, obviously there's different maturities.
Yeah.
So, do you invest in different bonds that have different maturities, or do you try and keep the maturity date the same?
Yeah. I mean, without going too technical, we do, yeah. I mean, because every country kind of has a yield curve. So what does that mean? Well, they've issued different bonds across time, and so they have different maturities. So if you issue a 10-year bond today, next year it's a 9-year bond, then an 8-year bond. So they issue across the yield curve, and then it's for us to choose the most attractive point on that yield curve. And what tends to happen is that the longer the instrument you choose, the longer the maturity, probably the higher interest rate it tends to have. That rule doesn't always hold, but that's kind of the thing, is that if I'm holding something for a long time, there's more risk, so I want slightly more return. Yeah. Whereas, if I bought something for just 3 months, the risk of something really bad happening in the next 3 months is quite limited. So my return that they're prepared to offer me is much lower.
Yeah, so effectively you're willing to receive a high return for a longer investment.
Yeah, the longer investment, that's what you want, isn't it? Because you're locking up your money for longer, in theory, so you want to get a better return.
Yeah, and if we go back to 2022, just in a big picture, is it easy to see something like this coming, or were a lot of people shocked by how quickly interest rates went up?
I think yes and no is the simple answer. I mean, when we were looking at valuations in bonds were quite expensive then. Did everybody expect it to go back as quickly as it did? I think that was the thing that kind of surprised people. And if you think back to COVID, what happened is initially the governments and central banks basically threw everything they had at the problem. They put a lot of fiscal spending in from the government side, and interest rates were lowered dramatically. You even got QE as well, trying to get rates as low as possible to support the economy through this period. And I think what probably surprised people is how well the economy kind of adjusted and went through this. And I think the reason is that everybody got to work at home, and it worked successfully. It's the kind of thing, if you'd have said to me at the start of it, Colchester are going to work at home for a year, I think you're going to be kidding. I mean, is this going to work? But it wasn't just a small company like us, but large companies as well managed it very successfully. So I think the economy stayed better, which meant inflation went higher. And even then, central banks probably thought, well, surely there's some damage to the underlying economy, but it wasn't as bad as people thought. So that inflation stayed higher, and there was suddenly a very rapid kind of rise in interest rates once central banks realised they'd maybe made a mistake by not moving sooner.
Yeah, so if we touch on inflation, at the start of the episode, we spoke about what's happening in the Middle East. Yeah. And as of today, I think the oil is at over $100 a barrel, and oil affects inflation globally, and also food prices and everything. Yeah. So how do you, there's a lot of uncertainty around how long this war is going to last for, what are you thinking as a team to, position your portfolio? Yeah.
I mean, this is one of the more difficult periods because it's kind of a push me, pull me for bonds. And what I mean by that is that obviously the impact of a higher oil price, as you say, it doesn't just affect filling up your petrol tank, but, if you imagine if you're Coles in Australia, you have all your food delivered to you in trucks, vans, this kind of thing. They're using energy. The farmers are using fertilizer. That comes. So the feed through into the economy can be quite big. However, as a central bank, if you've got very high oil prices, chances are the underlying economy is going to suffer. At its simplest level, if I have to pay more to fill up my car with petrol, that's money I can't be spending, on the coffee shop round the corner or whatever it is. So you'd expect the underlying economy to maybe contract. So central banks have got a very difficult decision of, do I hike interest rates to try and control this inflation, Or do I look at the underlying economy and think, well, if oil prices stay high, chances are the underlying economy is going to suffer. So I actually probably want to cut rates because I want to try and support the economy. Because what they'll say about the oil price is it will be temporary. Yeah, and let me give a good example of that. Let's say it goes up to 120. So you've had big inflation initially, but after 1 year, if the price is still 120, the way that inflation is calculated is what was the price 1 year ago. Yeah. So in other words, after 1 year at that level, inflation is zero.
Yeah.
But if you've collapsed the underlying economy in the meantime, then that's probably not a great job.
Yeah, because it's quite interesting because the Reserve Bank of Australia met yesterday.
Yeah.
And inflation's quite high at the moment, and they increased interest rates, well, the overnight cash rate from 3.85% to 4.1%.
Yeah.
And there were 9 people that voted, and 5 voted for an increase and 4 went against an increase. And the counter argument will be, well, if oil prices are high, it means there's less disposable income, and then interest rates go up, and the average person has a mortgage, so their disposable income drops even further. So it's really, at a certain point in time, they're making that decision rather than arguably looking forward.
Yeah.
So, it's quite interesting with Reserve Bank having the balance between, where's the economy going to be in 3 or 6 months versus where is it today?
Yeah. I mean, it's interesting because, once again, from a Colchester perspective, we've looked at Australia for some time as having slightly higher inflationary pressures than most other economies. Now, that sounds bad, but the good news is if you look, the Australian economy is reasonably buoyant, so that's good as well. That's why inflation is a little bit higher here. As for what the Reserve Bank did, I was quite surprised they did it. It doesn't surprise me there was a split because, as you say, it's a very difficult decision that they've got to make. Inflationary pressures were already quite high. They want to address that. But, there's something going on in the world that is very uncertain of how it's going to end. So I'd have thought they'd have done nothing, but, I don't want to criticise them too much because that's obviously not my job, is it?
Yeah, but your job is obviously to not necessarily predict what reserve banks are going to do, but have an understanding because that could have a big impact on bond prices.
Exactly, yeah. I mean, we don't try and predict what central banks are going to do because, like I say, we're very much valuation driven. However, it's the kind of thing we're always thinking about. It's almost impossible to work in the bond market and have no opinion on this kind of thing.
So we talked a lot about bond markets and Colchester, but we're here to talk about you as well. And so fixed income, it's quite unique. There's not a lot of obviously it's a massive market globally, and a lot of governments need to borrow and corporates need to borrow, and they do that through through markets. But how did you get into fixed income? Were you at university or high school and thought, I want to be a government bond manager?
Yeah. There's probably not many primary school kids you're going to go to and say, do you want to be a fireman, a spaceman, or a bomb manager? Then I go for number 3. I'll give you that. But, it was something that I suppose it came to me a bit later in life. I started university studying politics and economics.
Yeah.
And if you're interested in those 2 subjects, I think bond markets are a great thing to go into because it's that interaction of politics and economics that kind of drives prices. So you think about Argentina, the example we gave earlier, they didn't have particularly good economics or politics. It kind of went against them. Whereas, I think if you've got an interest in that, then like I say, bond markets are pretty good. Obviously, the other way is to go into equity markets. But I think you've got to have a real kind of maybe going into the industry kind of specifics and stuff like that, and a lot of financial analysis, which I've done some of in the past, but it wasn't quite as interesting, I felt, as looking at the country and the macro picture. Yeah.
So what was your first job out of university?
Yeah. So, well, first of all, I had quite a long university career. I'm quite lazy, so I I started doing politics and economics, but then I switched to politics and East Asian studies. So I studied out in South Korea in the early 90s. So, it was very interesting. I think when I was there were 50,000 foreigners. I've looked this up later. There's 50,000 foreigners in the country. And I'm pretty sure that included 35,000 American troops. So there was, we'd go out into the countryside there and, I've still got pictures of myself signing autographs for little kids because they said they'd never seen a white foreigner before.
And quite fair-skinned as well.
No, that's because I'm not from Australia, mate.
Fair hair, I mean to say, though, you're quite tan.
Yeah, but like I say, I mean, we'd go around and we'd stand out like a sore thumb everywhere we went. So I did that. I actually spent some time in Australia then. I was a backpacker here.
Nice.
I lived in Woolloomooloo in Sydney.
Yeah.
And I go there now and I've been told that Russell Crowe has a house on the wharf there.
Okay.
But it was derelict when I lived there. So
yeah.
it wasn't quite as glamorous as it is now.
Yeah.
So I did that. Then I did a master's degree at London in Korean studies. And then I went back out to South Korea and did further study there. So it was quite a long time before I got a real job. But my first job was at Baring Asset Management on their graduate training scheme in London. So it was about 99 when I started work.
Yeah. So what did the graduate program involve? Is it a traditional graduate program where you spend periods in different areas of the business?
It was. And it was a really good learning experience because obviously you get to see what you like, but also what you don't like. Yeah. And also it gives you a good idea of how the whole business comes together. Whereas I think, nowadays you tend to specialize a bit more early on. Yeah. And, you can just go through your one part of the job and you sometimes lose sight of what we're actually trying to achieve as a company because all you look at is your little silo and if I'm good at this. So hopefully people in my company think I'm reasonably helpful to the other departments because I've some idea of what they're doing.
Yeah. And then how long were you at Baring Asset Management for?
It was about 5 or 6 years I was there.
Yeah.
And then I moved to a company called Rand Merchant Bank. And by the name of that, they're a South African company. And I spent about 5 years there. So we were running their offshore global bond program from London.
So when you say offshore global bond program, for our listeners that might be not familiar with that.
Okay.
Or for the host who's got no idea.
Well, don't worry. It was quite unusual because, you see, the thing is, in South Africa at the time, you could only take 15% of your money offshore. So I maybe using a bit of terminology there. So the South African bank, or the SARB, the Reserve Bank there, who were doing regulations, said to like pension schemes and asset managers, I was working for an asset manager, you can only take 15% of your money offshore to invest. And it was quite interesting because I worked there through GFC and everybody used to complain to the Reserve Bank saying it should be a higher percentage, And then GFC happened. And of course, a lot of people who went and bought offshore assets got burnt. Yeah. So they thought they were geniuses at the time by having limited what you could take offshore. Yeah. So like I say, you're only allowed to take a bit of money offshore and I ran the bond portion of that in a team.
Yeah, okay. And then do you have any restrictions on where you allocated capital in that bond? I know it's a long time ago.
No, I mean, there were still restrictions around it. I mean, I think that once again, it was largely investment grade. We had a little bit of high yield, but not very much because once again, it was that kind of thing that, the vast majority of bond investors initially go in for a kind of secure, safe asset. Now, that doesn't mean that all bond investments are secure. You can go and buy high yield and things like this and really take a lot of risk. But most people like something relatively safe, and that's what I was doing as well.
And was that during the GFC that you were there?
It was through the GFC, that is correct. So,
and how I didn't work through the GFC. I was a uni student at the time. I was drinking my way through the GFC.
So was I, mate. It's pretty.
What? Obviously, it's you could argue probably once in a lifetime that we saw this happen. What were you all like? Maybe can you talk us through that experience?
Yeah, I mean, it's interesting because once again, when you're in the day-to-day of it, it's kind of easier to miss the big picture. But as you say, I mean, it was this like once in a lifetime, hopefully, kind of experience where there were huge moves in markets and there was huge fear in the market. So even in the UK, there were banks that kind of went under. And like we actually remember going with my friend one day because Northern Rock was this bank. I mean, in hindsight, what they were doing was absolutely crazy. They would give you 120% mortgage. So what does that mean? Is you buy your house and your house is worth $100,000 and they'd lend you $120,000.
So if you can't pay it back,
you've lost more money than the house was ever worth. You know what I mean? But at the time, insane. It was just grow the business. It's the rah-rah years. So Northern Rock were one of the first banks that went under. And, I went and actually took a picture of people queuing up outside Northern Rock to get their money back. Yeah. So, it was this extraordinary period to work through. And just before that, I'd been in Iraq with the army. So I think in Australia, you call it the reserve.
Yeah.
And I'd been in the TA. So we'd been out in Iraq. I was there 06 to 07. So I came back just as GFC was starting. I think I should go back to Iraq. It's safer, mate.
Let's touch on that. Yeah. So when you say you spent time in Iraq, so you were working at Rand Merchant Bank at the time.
That's right, yeah.
And then there was that a period between there. Did you get called out to Iraq?
Yeah. So what it was is I joined, when I went to South Korea, I got a scholarship from the British Korean Veterans Association.
Okay.
My uncle had served in Korea, and obviously, quite a few Australians served there as well. So I met some of the Australian veterans when I was there. They used to do these reunion tours, and I thought, they've all got these kind of like boys' own stories, and I thought this sounds really interesting. So I went back and I joined what's called the Territorial Army in the UK. Yeah. So it's like part-time, I suppose, like the reserves here. But by the time I got to Iraq, we were Telic 9, so that, we must have been there 5 or 6 years already. So we were kind of running out of regular soldiers to send there. So they were calling up reserve soldiers to go.
And did you have a choice whether you went?
Kind of, yes. I could have said I really don't want to go.
Yeah.
But really what I'm saying in my regiment is, lads, my life is very important.
Yeah.
But yours isn't that important, because if I didn't go, somebody else would go. Yeah. So once I got called up, it was, it's kind of okay.
Quite a unique experience. And what, during that time, how long were you in Iraq for?
About 7 months.
Yeah. So what skills did you learn in that period, whether it be a mindset skills or I guess your mindset, that's helped you to be, the best investment manager today?
Well, I'm not sure I'm the best investment manager, but what helped me make it better, what made me be better than what I was.
Yeah.
I think staying calm and under pressure, because obviously the pressure environment there is, if we get this wrong, we're dead. Yeah. And when you're under fire and stuff like this, if you lose your head, it's not great. Now, once again, so you come to it back to investment, if it's being able to kind of maybe separate yourself from the day to day. Like I say, when we went through, GFC, there's so much going on, but you kind of need to stand back and take, in the bigger picture of what's going on rather than just reacting all the time.
Yeah.
And I think that's one of the things we do quite well at Colchester without, going overboard. But because we've got a valuation metric that we're looking at, it helps you through the difficult times because you've got something to anchor yourself to. Whereas, I think just reacting to events doesn't always help that much. Yeah,
and there's a lot of talk around retail investors tend to react a lot quicker, where institutional investors or asset managers, fund managers tend to know what their valuation is and ultimately stick to their long-term goal or process, but can be obviously challenging when you have a hopefully once in a lifetime event like the GFC.
Yeah, and like I say, it's the old one that every crisis tends to throw up something slightly different.
Yeah.
And you've got to react to that. Now, whether retail investors do a bad job and institutionals do a good job, I'm not sure it's quite that simple. Sometimes in hindsight, I think maybe I should have reacted a bit quicker. But I think having some kind of framework around the way you invest doesn't have to be the same as what we do, but having a kind of way of thinking about it, I think, is quite useful for the medium term, at least. Yeah, definitely. And then from RMB, Rand Merchant Bank, you went to Mercer? I went to Mercer, right? Yes, that's right. So Mercer is a pretty big business, global business, but what part of the business were you in and what were you doing? So we were in something called investment consulting, and in the UK, there's lots of called defined benefit pension schemes. Yeah. And what they are is, say in Australia, you've got a super, so you invest in your super every month, and at the end of your time, your retirement pot is basically the money you put in and how well the investments did. So all the risk kind of is on you. Yeah, the investor. Defined benefit pension schemes are almost the opposite, where if I worked at a company all my life, they would give me 2/3 of my final salary and they would index link that. So all the risk is on the company.
Yeah, okay.
There's not many of them left, but basically
Yeah.
Mercer, its main business on the investment consulting side was advising these kind of companies on how to invest those pension schemes.
Yeah. So in other words, you get a guaranteed annuity for life under a defined benefit, and obviously that guaranteed annuity, the risk is by the person that's provide or it's the
company, because it was the company who were providing it. So, if you worked in the past, if you worked at, Lloyd's Bank in the UK, they would give you a defined benefit pension scheme where they would guarantee your pension essentially.
Yeah.
Now that's kind of changed over time because it was such a big risk on the company.
And especially during COVID when interest rates went to zero, then, you can't get a risk-free income rate of return. So these people that are guaranteed to get this annuity, it's hard to provide that.
Absolutely. And it was very interesting when I worked at Mercer, but without going into the technicalities of it, but interest rates were a bigger kind of mover of the deficit or surplus of the fund rather than the equity market. So you think, well, if the equity market's up, you're in a surplus? Not necessarily, because if interest rates are very low, you had to discount back what you were going to pay out over time. So low interest rates was very tough for them because you say they couldn't get a risk-free income coming in. Yeah. And also their future liabilities were discounted at a much smaller rate, which meant they look bigger.
Yeah, and that's a lot of what you do is matching future liabilities. Is that right?
Is he going back to our Liz Truss moment? One of the reasons the UK bond market reacted is the way it did is that in the UK, as you say, these companies what they wanted to do was buy government bonds in the future. So why do you want to do that? Well, if you know you have to pay Martyn X money in 20 years when he retires, what can give me that guarantee? Well, if I buy a government bond that matures in 20 years, I can pay Martyn then. So it was a very nice trade for them. They wanted to do this, but if their pension scheme wasn't fully funded, they couldn't go out and just buy government bonds because they didn't have enough money. Yeah. So what they did is they got asset managers, not Colchester, but different ones, to use derivatives to kind of hedge their future exposure. Yeah. And then they would use the current money they had to go and invest in riskier assets to hopefully gain them the money that they could then just close out all these derivatives and just use government bonds. Yeah. So what happened is that, well, it's kind of low. It's a low probability, high risk business. Yeah. And that went wrong because as soon as Liz Truss announced her budget, and things started to go wrong in the gilt market, you were losing money on your derivatives in the future. Yeah. So you had to find money in the short term. And one of the things they could sell very quickly was other government bonds they owned. Yeah. So they sell them, the price goes down again, you're making bigger losses. And well, thankfully the IMF didn't have to step in and save us this time. But obviously the Bank of England had to step in, and there you go, and Liz Truss is no more.
No more, yeah. So if you, from what I've heard during this discussion, which I've really enjoyed, is obviously, you've lived in Korea, you've lived in Iraq, you've lived in Singapore, you're obviously originally from the UK.
Dubai, lived in Japan.
You lived in Dubai, Japan. Yeah. Surely understanding all these different economies and how they react and interest rates, etc., has put you in good stead to do what you do today?
I think so. I mean, you can in some ways you can overdo it because they say that sometimes the worst person to ask about something is somebody who lives in that country because, if I turn up to Australia, I think, oh, what a great place. Look at all the sunshine and you've got these great beaches. But, you talk to an Australian taxi driver, he might give me a slightly more downbeat version of living in Australia because you know all the problems as well. Yeah. But I think, it is a good experience to go and live in these places, see something different and bring all that experience back to your job. So I think it's helped me anyway. Let's put it that way.
Yeah, definitely. And if you are an advisor, financial advisor, that you are looking at allocating to, a fixed income fund manager, what are some questions potentially that you might want to ask? Now, I'll put you on the spot. I don't normally ask this question, but sort of come to me because obviously there's, a lot of different funds available, but what are some key things that you'd want to know about the fund? Obviously portfolio manager and working through various crisis, which would be very important. You mentioned the GFC, because there would be some portfolio managers that never experienced it, like myself.
Yeah. I mean, experience is good. But, for all you know, he could have lost a fortune in GFC.
Yeah,
I suppose maybe he wouldn't make that mistake again.
Yeah.
I mean, experience is certainly good. I think, it comes back to that. What's your core philosophy and how do you invest over time? Because certainly from my time at Mercer, we go and see lots of fixed income managers, and some of them, paraphrasing a bit, but realistically, what's your process? The process is we've got a couple of clever guys who make some really good decisions.
Yeah.
And that can work, but if that starts to go wrong, when do you get rid of that manager? When is the clever guy, if he leaves or she leaves, how badly does it? Whereas if you've got some kind of fixed philosophy that you're always implementing, it doesn't mean you're always going to outperform, but at least you get a good idea of what they're going to give you through time. So I think that's kind of important. And then obviously, just simple things that you probably ask an equity manager, risk control. How do you size your positions? How do you think about exit a position? Pretty simple stuff of the nuts and bolts of how it all fits together.
Yeah.
But to me, I'd say it was interesting because once again, I worked at Mercer, so you got to see lots of different people do it. And what I've noticed is that there's no one right way. But the companies I thought that were the best, or the portfolio managers I thought were best over time, were ones that had a very set idea in their mind of how they were going to invest over the medium to longer term.
So longer term view, process driven, valuation driven.
Like I say, I mean, that's the kind of way we do it. Valuation doesn't necessarily have to be valuation. There's other factors they could have looked at.
Yeah.
But at least they're consistently doing something, because I suppose then is like there's no guarantee they're going to get it right. There's no guarantee anybody's going to get it right. But it means that when you buy into that fund, you have a very good idea of what might happen through different conditions.
Yeah, and there's obviously going to be external factors like what's happening in the Middle East or, reserve banks that, you have no control of. But what is your process if something like that happens?
Exactly. How do you think about these issues when they turn up?
And last question, because we have been talking for a while. And obviously, we both have share a level of passion about investment markets. But what advice would you give to maybe someone that is a uni student or a young graduate that wants to work in fixed income?
Yeah.
What advice would you give him to get to where you are today?
Okay, I'll tell you what. This is interesting because I've interviewed grads. So you're coming fresh out of uni and you've come, not necessarily, I don't think I've done it at Colchester. Maybe I've scared people off from letting me interview them. I don't know, but I've done it at other companies. And I think you've got to demonstrate that you've got a real passion for it. To getting your first job I think, out of university is the hardest thing. Why is that? Well, heaven forbid I left the mighty house of Colchester today. Well, how many jobs are out there? Or, if there's a job looking for somebody with 25 years experience who can speak Korean, whatever it is, what I mean, and is in bonds, there's a very small number of people applying for that job. So I've probably got a 1 in 5 chance of getting it if I apply for it. When you come in at the graduate level, I interviewed at Barings and it was quite good because I got in there.
Yeah.
I think there were 800 applicants and 4 people got a job.
Wow.
So I think to myself, did I ever have a 0.5% chance of getting a job after that? No. So your first job is the hardest. And I think what you've got to show is that you were really interested in markets and investing. Even if it's just read the Financial Times every day or read, what do you call it in Australia? The Australian
Financial Review,
Australian Financial Review. Just read it every day. Give yourself some knowledge, because even people who'd studied, say, economics and things like that, we'd ask them questions. Their economics knowledge was very good, but we'd ask them a question about the market and they'd just give us a blank look.
Yeah.
And,
so you got
for something that in theory, if there's something, well, first of all, I'd advise you not to come into it if you're not passionate about it, because it's a hell of a long career, if you're not enjoying it. But if you are trying to convince somebody that you're genuinely interested in this and you don't know the basics of, what's been happening in the market, what the implications of, so you understand the economic theory, let's follow that through on what's happening now with oil prices or something. Yeah. If you can't do that, you're probably going to struggle to get your first kind of job. And like I say, and that's the hardest.
Yeah. Be curious. be interested.
Absolutely. You know, nobody's ever said to me, Martyn, I think you've read too much.
I agree. And it's interesting because a quote that I say a lot, the more you know, the more you realise
you
there's
don't
a
know.
lot you don't know.
Exactly.
Yeah.
Even now, there's stuff, I suppose, that, you know, every situation is new. So suddenly, like the Straits of Hormuz, I'd heard of that loads of times. What happens if that gets shut? And it suddenly is shut. And I'm like, well, how big is it? You know what I mean? And you got to go look this kind of stuff up. And there's always something new to be learning about, you know, especially when we look at us for countries, you know, the countries are always changing.
Governments are always changing.
Exactly. There's always something you can be learning.
Yeah. Well, Martyn, thank you very much for coming on the Finance Friends podcast. I've enjoyed the discussion and clearly passionate, and wish you all the best with your future growth with Colchester.
Okay. Well, thanks for having me, and I've really enjoyed it myself. Thanks a lot.
Cheers.
Cheers.
Thanks for listening this week. Stay tuned for our next episode and keep up to date with us by following the Finance Friends podcast on Instagram and TikTok. Plus, connect with us and our guests over on our LinkedIn page, all linked in the show notes.
Disclaimer, this podcast exists for informational and entertainment purposes only. The personal opinions of the speaker and guests do not represent the view of any other party. If this recording contains reference to financial products, that reference does not constitute advice nor recommendations and may not be relied upon. Information relating to Colchester Global Investors is only relevant to wholesale clients or wholesale investors and is not suitable for retail investors.